So when I ran this strategy, it has given me 4.7 lakhs of profits after slippages and everything. So from 2017 to 2022, if we started trading live, then if you could see from 2019 to 20, everything has changed. So 2019 to 20, Monday to Friday, except Tuesday, 25% stop loss is good. On Tuesdays, only use 50% stop loss. So Monday to Friday, say suppose I've entered at 920. So what is the overall profits that this specific first entry has made? And what is the overall profit the second entry has made? I could see, okay, if I could run the strategy only on expiry days, there is two things. I don't need to worry about the markets every single day. So it keeps peace of mind. And second thing is, by ignoring all other days and trading only on expiry days, even though my profit is lesser comparatively on all other days, still I'm happy with it because my drawdown has been significantly reduced.
Hello guys, welcome to another crackling episode of Trading Ki Baat Grow Ke Saath. So far we've had some esteemed guests on the panel and I hope this has shortened your learning curve. If you have any suggestions for us, then please leave your feedback in the comment section below. So without further ado, let's introduce our speaker for today, Mr. Kirubakaran. Kirubakaran has about 15 years of experience in the stock markets. He did his graduation in BSc Statistics from Loyola and MBA from Symbiosis University, Pune. After graduation, Kiru moved on to work in MNCs like Infosys, Bank of America for 10 long years. He finally quit his job to focus on his own startup. He's the proud founder of the algo trading platform SquareOff.in. He has been vested into the markets full time since 2017. Let's learn more about him and his strategies from the man himself. Hi Kiru, welcome to Trading Ki Baat with Groww. How are you doing?
I'm good, Arjun. How are you?
All well, all well. Today is Thursday and more like a holy day for option traders, especially intraday. How did the day go for you?
Yeah, it went well. So it not only for me, most of the option sellers, it should have been a good day for them because after a long gap, I think back to back good expiries has been happening and the volatility has been going down steadily. So I hope this continues for most of the option sellers.
What kind of systems do you trade? Are they mostly intraday, positional, and what is the nature of these systems?
I trade only intraday. I don't do any positional trading. With respect to investing, I used to follow certain rule-based mechanisms earlier to quantify certain stocks and invest on them for short-term trading. But later on, completely scrapped that, and I'm sticking to only index funds investing. So basically, I invest 20% of my income back to index funds, and I pledge that and use that as a margin to trade intraday.
Wonderful, wonderful. Uh, Kiru, you've been trading systems for a long time now. How and when did you get started with systems trading?
Actually, it could be divided into three parts. So initial phase, I started trading as a normal trading in 2008, but between 2008 to 2014, it was completely random trading. So completely, it's a news. No, mostly it's a news-based trading. Whatever people discuss in news or whatever people discuss in forums, I just get into those stocks, buy that, sell that in a week. But later on, it took so much of time. Like I have to manage my day job as well as trading. So doing trading manually and that too without any specific rules, it really did not work for me. And then I moved to systems trading in the year 2014. So that was the year I started algo trading. And back then, not many brokers were giving API back then. So only recently many brokers started giving API. So back then I started trading through Symphony FinTech. So those were the algo trading providers back then. And from 2014, I started getting into systems trading. And initially, just like any people who move from news-based trading to rule-based trading, I too thought that no algo trading removes emotion and it gives you a consistent profit year on year or month on month. But that is not the case. So again, from 2014, it took me some couple of years to understand the basic logic behind systems trading and the emotions and all the important elements related to systems trading. It took me some 4 or 5 years, and then completely shifted to emotionless trading right now.
So, Kiru, you have such a vast experience of the markets and you've been trading for a very long time now. In your experience, how have the markets evolved over these past few years? And, what is that thing that has remained the same?
All right. Yeah, with respect to, I've been doing algo trading from 2014, and there is two things that has been completely changed. When I started, getting into this algo trading, it costed me almost 1 to 1.5 lakhs per year just to run all the infrastructure costs, the server, the charting software, the licensing fee, and everything. Because earlier, none of the brokers were providing API. So I have to. There were only few set of brokers who were also using the third-party algo platform program solutions. So you need to buy a licensing fee from charting platform like AmiBroker or Ninja Trader. Back then, TradingView also not popular. With I'm not sure whether even they've launched it or not. And we need to buy a data feed from TrueData, GDFL, and then link it to the charting platform. And whenever the charting platform triggers any signal, the order goes through the execution platform. So it costed a lot when I started algo trading in 2014. But now most of the brokers are giving free APIs, and also the data feed is also free from the broker side. So it is much easier right now, and it is more affordable. That is why more people are getting into algo trading. And second thing is ease of back testing. Back then, if I have to test a specific strategy, I have to write some 50 or 100 lines of code in platforms like AmiBroker, where, and also even if there is a small mistake that you do, it's hard to rectify where the mistake is, and it's really difficult to backtest a simple trading strategy. But now there are multiple no code platforms out there, which makes it more easier for the people to get into systems trading. So this is the two things. So one is cost, and second thing is ease of access to these tools, which makes it more affordable, and also makes it more easier for these normal traders to get into algo trading through backtesting and the execution part. And these things completely changed. One thing that does not change is the emotional part. So be it manual trading or be it algo trading, so as long as your money is into the where your money is at risk, definitely the emotions will be there. It can't be removed through algo trading. So algo trading removes an emotion is a myth.
I was exactly coming to that point that when people say that algo trading, cuts down the emotions, so that that is like a myth. And since you and I have been doing algo trading, we know that when you have positions on, emotions will be there, whether it is algo or discretionary.
Very true.
Backtesting, as you said, has become very popular these days with so many tools and platforms coming up for with different retailers for retailers. Uh, but despite that, people complain that the backtest results and the actual trading results vary a lot. As per you, what is it that people are doing wrong that leads to such differences?
See, with respect to backtesting, there is a different approach. For an example, consider you are trading based on a moving average system, a normal moving average system. So most people, what they say, consider if a 50 moving average or 100 moving average, whatever moving average, whenever a particular stock goes above, for an example, 200-day moving average, you buy it, and when it goes below 200-day moving average, you sell it. So this is one simple systematic approach towards buying and selling based on a moving average. So now you tend to think, okay, 200-day moving average might not work for this stock. So probably for Reliance, maybe I need to optimize it, and I need to find, add two more moving average. So when 50 moving average crosses 100, I'll buy it. So if I apply the same thing to SPAC, maybe it would not work. So probably I need to use 32 and 52, and you keep on changing these parameters. And in backtesting tool you have this optimization parameters where you just go and optimize it. It will tell you based on the past data. It tells you, okay, these are the best moving average that you could apply, so that it gives you this much profit. So that was also one of the mistakes that I did during my systems trading journey, where I used to find what is the best combination of moving average for different stocks based on the previous data. Actually, what I was doing is I was just curve fitting. And so whatever the best parameter which you have found that is really successful for the past year might not be working for this year, because the pattern keeps changing. So obviously, for an example, Reliance was stuck in a range for 8 to 10 years for a prolonged period of time, and then from 2017 onwards it started rallying. ITC would have been stuck in a very narrow range for a long time, and it started rallying. Similarly with many such stocks. So it is very difficult, for a trader who wants to backtest and gets into systems trading, if he thinks that, okay, based on the past data, based on the optimizer feature, if I could find out the best combination, I could get the best result. So that is what most people think. I have one slide also for that. Let me see if I could share it with you and see. Consider this as an example. People who wanted to get started with backtest. I'll tell you what is the layman's approach. So initially, what they do is they have this two different stop losses. Consider, let us use a 920 short strategy for an example. people, as per the strategy, they have to enter at 920 and exit at 320, and they use probably a 25% stop loss. And whenever the stop loss is hit, they have to exit it. This is a most widely used strategy that most people use. So they have two options, whether they can use a 25% stop loss or 50% stop loss. So now they go to a backtesting platform. So I'm using a stock market backtesting platform as an example here. And from 2017 to 2018, I wanted to check whether 25% stop loss is good or 50% stop loss is good.
Okay.
And I go and backtest from 2017 to 18. So that based on whichever is profit, I would use that as a stop loss and proceed with it.
Okay.
So my backtest says that 25% stop loss versus 50% stop loss. It shows 50% stop loss has given me higher returns based on the backtest period that I have given, 2017 and 18. Consider as we are in 2019 going to start the trading. So previous 2 years we have data. So obviously we'll test it with those previous 2 years. And we could see instead of 25%, 50% stop loss is good based on the backtest results. So from 2018 onwards, you would start trading live with a 50% stop loss. So this is the normal approach that 99.9% of the traders follow. Now, consider for the next 2 years, from 2019 to 2020. So for the same rules, 25% stop loss and 50% stop loss, same 920 short strategy. And when we are trying to test it for the next 2 years, 2019 and 20, it shows that 25% stop loss is good. So earlier, whatever the things that you backtest, which shows that 50% stop loss has given you highest profits, now 25% stop loss is giving you highest profits in the next set of years. So this is the mistake that most people do. So based on the previous set of data, if you absolutely confirm or if you absolutely fix everything, okay, this data based on my backtest shows that this percentage or this parameters are good. So they probably proceed with those parameters. And when they deploy it in live, they see a huge difference. Right. So that is what I told you, like when you are using a best moving average, I tried finding it out what is the best moving average for S Bank. And it showed me 35 is the best moving average that I could use, which has given me the highest returns for the year of 2016 based on my backtest. Now, again, on 2017, if I could see, it showed me best moving average is 75, not 35. In fact, 35 is at the bottom actually. So the best moving average that we tested in the 2016 seems to be the worst moving average for 2017. So we can't optimize the data to find out the exact end results, and accordingly if we proceed, this would be the problem. So that is the most, and second most important thing is when people started using day filters also. For an example, they think that okay, Monday is a volatility day or Friday is volatility day, so I can't use the same 25% stop loss on each day. Probably I need to alter my stop losses on day wise. So they tend to think, and again they tend to use those optimizers and try to find out on which day I should use 25% stop loss, on which day I should use 50% stop loss. Because the backtest data would, the tool would simply go and run all these permutations and combinations and give you the desired result. So if I do the same thing for 2017 and 18, it exactly shows like this. So Monday, Wednesday, and Friday, you run 25% stop loss. Tuesday and Thursday, you run it with 50% stop loss. If you do this, you are going to get the highest returns. So every systems trader who's doing this backtesting, they'll think, okay, this is going to give me the best returns. So I'm going to use this combination where 25% stop loss is good on Monday, Wednesday, and Friday. And other 2 days, I'll use 50% stop loss. But the thing is, this is good combination only for the period of 2017 to 18. And if you could remember, 2017 is the lowest volatility ever.
Lowest volatility, right?
Yeah, so intraday wise, it was the lowest volatility. Only from 2018, we started seeing volatile period. And if I go and check, okay, 2017 and 18, these were the combination. How about 2019 and 20? If we started trading live, then if you could see from 2019 to 20, everything has changed. So 2019 to 20, Monday to Friday, except Tuesday, 25% stop loss is good. On Tuesdays, only use 50% stop loss. So whatever the combinations that we see during the earlier year has completely changed now. This is again because the market regime changes, the market pattern changes and everything. So you can create certain things, based on a normal logic. You're using a 25% stop loss and do it. but using different stop losses on different days, using different time frames, and no different entry time, different exit time. So these things, if you do it, you end up curve fitting it. So it's better not to use or over optimize your systems accordingly. That is what
I
I
think,
would recommend.
wonderful examples for curve fitting. You explained very well what really curve fitting is through practical examples. And this is the mistake most people are making, that when you try to extract the best parameters on a given data set, uh, that would likely work on that data set, but probably in the future, the market or the regime would change, and that would absolutely stop working. Or another particular moving average, as you said, or a percentage stop loss, that would probably be a better fit for that. So all this keeps changing from time to time, and to absolutely fit something to a given data set and consider it to be the best is not the right strategy. And that probably falls in the curve fitting category, and that is why the
Right.
results are not as per the back test as in real trading. So great example. Uh, Kiru, I believe more than just the strategy is what matters is the process that you follow to design and build your trading systems. And everyone has a different way of analyzing and backtesting their setups. Uh, I would love to know what kind of a criteria do you follow while building your systems? What kind of an approach do you follow? Would love to hear that from you.
Yeah, first I'll know, instead of getting into having a fixed thought process in your mind and then going directly and testing out. Say suppose you can't directly go to a tool and say, okay, I'm going to test a straddle strategy. I'm going to test a strangle strategy. But no, you don't come and have a fixed set of mind in your, like for an example, consider that you wanted to test a back some strategy, and most people will look for, okay, what is the best trading strategy in the net. They'll say, okay, straddle, strangles, short strangle, multiple things will be there. And directly they'll go and start back testing. Okay, many people have said 920 short strategy. Probably let me test with 1020 or 1120. So they have a fixed thought process in mind, and then they go and test with the backtestable historical data. But what I would say is find out certain core elements. For an example, Thursday, if you do a historical data analysis from 2010 to 2022 for the last 12 years, take Bank Nifty historical data and see how day wise the Bank Nifty has moved. And if you could see from Monday to Friday, the movement is almost random. Like every single day, there will be volatile movements that has happened. But post 2017, if you could see, the intraday movement on Thursday has drastically reduced compared to all other days. That was because from 2016 June onwards, the weekly options was introduced. Since then, the Thursday options, since that was the first time weekly options being introduced in India, so more and more people started getting into option selling. And by 2017 onwards to till date, Thursday has the least volatile days compared to all other days. There will be days, definitely 1 or 2 days, where the volatility will be there. But Thursday, you can't see a huge trending moves. So even you would see, a flat move, or you would see a zigzag move, but market doesn't give you, a big trending days very often on Thursdays. So which means that any, an option selling system which can control your risk, if you had applied for the on expiry days alone, then it could give you a good returns. And rest of the days, it could be trend following days where you can use, for an example, 920 short sell strategy is kind of a trend following system, because one leg is out much earlier and the other leg keeps on riding. So you have a built-in mechanism based on how the market has behaved in the past. There should be core logic element. So here the core logic is obviously because of the introduction of weekly options, the Thursdays has been impacted. And because of that, there is not much movement, and you can implement any specific option select system on Thursdays and make use of it. And since that is going to be an expiry day, your winning ratio will be much higher. So that is how I created a system which I told which I shared you the PPT. So that is also
Yeah.
like that.
Okay. So Kiru, like, do you have an example to show us the
Yeah,
methodology
I'll
with
open
which
that.
you go ahead with backtesting your systems?
I'll show you that. Okay, fine. So I'll go through. I'll just explain a specific trading strategy where any users could use it for non-expiry day specifically. So when I created this trading strategy, I did not have anything in my mind. I did not have any specific rules that I wanted to create a trading system. I just wanted to create a trading system, not specific to expiry days. I just wanted to create one system, an option selling system. So that is what I had in my mind. So most people are already familiar with strategies like 920 short strategies, using a fixed stop loss on individual decks and getting out whenever a stop loss is hit. So I wanted to create a strategy that could make use of the reversals. For an example, as you most of the time, if you see market moves up and again comes down, again moves up
Right.
and comes down, it keeps zigzag throughout the day and does not give you any specific trends. So as a guy who's always following a specific trend following strategy, if you could add an additional strategy which could make use of these random movements or random zigzag movements, then he benefits out of it by running an uncorrelated system. So I wanted to create a specific strategy that could benefit based on these zigzag movements whenever there is an absence of trend. So I wanted to create a rolling straddle. The logic behind the rolling straddle is, you, as usual, like 920, you create no you short an ATM options, both call option and put option at 920 with the bank nifty, both call option and put option at 920. You enter it, and what you do is, instead of using any fixed stop loss on your premium, say suppose if your premium is 100 rupees or 200 rupees,
Okay.
don't use stop loss on the premium. Instead, track the underlying. So our underlying is bank nifty. So whenever
Okay.
bank nifty moves to a certain level, we are going to close the position and initiate a new push. So that is the rules.
Okay.
Because
So
here it
Kiru, from what I understand, like what you're doing with this strategy is basically adjusting your delta. After a
right,
certain movement, you are again readjusting the delta so that position becomes delta neutral once again
right,
with as the market moves. Okay.
right. So that is what we are doing. So the good thing is, when you're using a fixed stop loss on a premium, you have to keep the stop loss into the system. Whenever
Yeah.
spike happens, it hits your stop loss, and again it goes
Right.
back in your direction. So people lose because of those spikes. Since here we are using based on the underlying move, which is on the bank nifty. Whenever bank nifty moves 0.4%, so it could be anything. It could be 0.3%, 0.5%, 1%. I just used 0.4 because on an average, the point wise it would be around 100 to 150 points. So
Okay.
whenever Bank Nifty moves 0.4% from your entry price, so we are entering at 920. So from 920, if Bank Nifty moves 0.4%, the underlying moves on the upside or on the downside, then we will exit both the call options and put option and initiate a new straddle.
Okay.
And say suppose 920 we entered and the Bank Nifty moved up more than 0.4%, then we will close the position and initiate a new straddle here. And if
Okay.
Bank Nifty cools down here, then not a problem. As long as it doesn't move beyond 0.4%, these strikes which we have entered will decay. But if it keeps moving, say suppose it's on trending day, so as long as market is zigzag, it's going to give you profits. But if market keeps on moving, we can't keep initiating a new straddle because that could end up in higher losses. So we have a re-entry limitations where only 5 times we could re-enter. After that,
Okay.
you close all your positions, no more re-entries. So start at 920, end at 320. So as long as Bank Nifty moves 0.4% from your entry levels, you keep initiating a new straddle. If not, say suppose if the Bank Nifty is stuck within a tight range, then there will not be multiple orders that will be triggered. So this way we are making use of all these V
Okay.
shape, U shape, inverted A shape,
Right. Right.
all
Right.
kind of
Right.
non-trending days.
So you're moving along with the market as it moves.
Right.
And
So
Kiru,
this
this
way,
0.4% movement, are you tracking it from the strike price or from the given level where you enter?
from the given level of Bank Nifty, say suppose if Bank Nifty is at 40,000 level when you have
Okay.
entered.
Yeah.
So from 40,000, if it moves 0.4%,
Yeah. Okay.
from 40,000, if it moves down 0.4%,
Right.
then you
Right.
initiate a new straddle. Otherwise, you hold on to the same straddle.
Got it.
On expiry day specifically, I've seen it did not move much. Bank Nifty, the ranges is very tight. So at the max, it could trigger just one or two straddle max, and it would work well. That was the assumption I had. So I wanted to test first with how it has worked on all days. So let
Okay.
us run the strategy on all days. Whether first of all we need to find whether it's profitable or not. Then only we can think further, right? So when I ran this strategy, it has given me 4.7 lakhs of profits after slippages and everything. So from 2017 to
Wow.
2022.
And how much of a slippage did you consider for the same?
0.5%.
0.5. Okay.
So 4.7 lakhs of profits with 35,000 drawdown, which has a 60% winning accuracy and 0.28 expectancy, and how many number of days the system is in drawdown. So that is more important criteria. So whenever you are designing a system, most people look the first part, which is the 35,000 part, and they think, okay, 35,000 is a drawdown, but you need to psychologically see whether you would be able to withstand a maximum drawdown days. Maximum drawdown days is nothing but how many days you are underwater. So how many days it takes you to recover from the drawdown. So it takes you almost 180 days, almost 3.5 months it's going to take in order to recover from the drawdown. And average profit per trade is 300 rupees. So this is the overall returns of this strategy running from 2017 to till date on Bank Nifty weekly options.
Okay.
So now I'm not still convinced. So I'm thinking, what are the other things that I could explore from the system? So what I could do is I could go and change the parameter from 0.4 to 0.5, or change the entry time to different level, or I can play around with those parameters. But instead, I want to dig deep into the data and see what else this could give me. So then I calculated the day-wise profits. So we have a different re-entry mechanisms, right? So initially we enter at 920 first straddle, and whenever Bank Nifty moves 0.4% from the underlying, we exit that straddle and initiate a new straddle. So likewise, we keep initiating a new straddle as long as Bank Nifty moves 0.4% on either side. So likewise, it has given me 6 different entries. So I wanted to find out what is the summation of my overall profits that has been coming from each of these trade sets. So Monday to Friday, say suppose I've entered at 920. So what is the overall profits that this specific first entry has made? And what is the overall profit the second entry has made? So likewise, I calculated Monday to Friday. And then from first entry to the last entry, I have calculated what is the overall entry. Then I could see that, for an example, most of the days, except Monday, Tuesday, Wednesday, Thursday, it's been in profits, but Monday and Friday, it is not profitable. So this is the overall outcome that I could see from day-wise.
Looking at this day-wise table, would you say that it is not suitable to do this kind of a strategy on Fridays, or would that be like we are curve fitting on particular days?
No, the first rule is we need to find out whether how many re-entries we should take. I just gave a 5 re-entry. So should we really go with 5 re-entries, or should we limit it to first 2 entries, or should we limit it to 4 entries? So the number of entries, I wanted to reduce it first. So I did a further analysis, and that shows me like overall my profit is 4.7 lakhs. Fine. But the first 4 entries has given me 94% of the overall profits. So the last 2 entries, the 5th and 6th entry, did not give much. So considering 26,000, we can just omit it. So we can stick to only the first 4 entries here. So instead of fine tuning the more parameters, I just figured it out. Okay, I don't need to trade, even though it is profitable. The last 2 entries, just remove it, because you're going to get 94% of the overall profits from the first 4 trades itself. So let's stick to that. So that is the first pickup point that we could take from the overall data. So in all entries versus the 4 entries. So the first 4 entries is really good to go with. So from here, we decided to go with the first 4 entries. And I wanted to check further, like, on what basis from Monday to Friday, what is the average profit that it has made from each trade? First entry, second entry, third entry. So this is summation. This is average profit per trade. So all these things that you see, 24 rupees, 25 rupees, 67 rupees, all these these are very minute profits that you're going to make, but that is not going to cover up cost, or it doesn't make sense trading this strategy, even though it is profitable at the end. So I thought, okay, it's better not to trade all days. But on Thursday, if you could see, Wednesdays and Thursdays, all entries it made profits, and also the average profit per trade is comparatively higher on expiry days.
Yes.
Compared to all other days. So I figured out, okay, what would be the overall returns if I trade the strategy on expiry days? So again, I ran the overall returns, and I could see it gave me 3 lakhs of profits. So compared to 4.7 lakhs, it is almost 65 to 70% of overall profits has come from expiry days. And the maximum drawdown earlier we saw it is almost 35,000 when trading all the days. So now the drawdown has gone down to just 5,500 rupees. and the winning ratio also increased to 75%, and the maximum drawdown days, which we saw as 118 days, has been considerably reduced now. So now it's just 7 days. So compared to all days and expiry days, I could see, okay, if I could run the strategy only on expiry days, there is two things. I don't need to worry about the markets every single day. So it keeps peace of mind. And second thing is, by ignoring all other days and trading only on expiry days, even though my profit is lesser comparatively on all other days, still I'm happy with it because my drawdown has been significantly reduced. So earlier from 35,000, it's just 5,000 now. And winning accuracy also increased, and expectancy also increased. And above all, I need to be under drawdown for 118 days if I have to trade this strategy on all days. But if I'm trading this on only on expiry days, only 7 expiry days have been under drawdown, and that too just 5,000 of overall maximum drawdown. So it psychologically, it would help me to stick to the system, and also it is profitable compared to like all days. It's not like not at all profitable. So the drawdown from 35,000, it has gone down almost to 6,000 rupees throughout the period from 17 to
Yeah.
22. And year wise also it is good. For an example, if I'm considering just 2 lakhs per lot to trade this strategy, and on average it has given me 25% of returns, and the drawdown is less than 5%. It is just
And the
2%
returns
drawdown.
returns have also been very consistent as well as the
Yes,
drawdown.
exactly. It did not deviate much. So it's not like one year because of high volatility you made huge returns. Next year because of absence of volatility you did
Correct.
not make huge
So
returns.
it's been working in different kinds of environments.
Exactly. 2017 being the lowest volatility, 2020 being the highest volatility. In both the years it made profits. In both the years the drawdown is also constant. That it did not deviate much.
Wonderful analysis, Kiru. I think what you've essentially done is that by digging deep into one of your systems, you've been able to figure out that this particular strategy works best on expiry days, and you found evidence that it does not fit you well to run it on the other days, as the profitability is much lesser consistently, and
Exactly. And
probably why, yeah.
more important point is I did not have any pre-built idea in my mind to create a system on expiry. I just wanted to create a system, but no, by removing all the noise I could figure out, okay, this is suitable for expiry. And second thing is, most people who I have seen this approach, like people who have a lower capital, they always aim for higher returns. People who have a higher capital, they always aim for lower drawdown. So because with respect to 25% of returns, people might think, okay, it is not that much. But no, if you know this rule of 72, where no, you just have to divide the total returns that you're going to get from your trading strategy. You divide that with 72, that would tell you how many number of years it's going to take to double your capital. So if I'm trading with 10 lakhs, if I'm trading the strategy with a 25% returns, and it's going to take me just 2.5 years to double my capital. So people who have a higher capital, they want least to draw down, so that they don't want much shock, and psychologically it helps them to stick to the system also. So I would suggest people to look for a moderate returns and with a least drawdown instead of aiming for a higher return strategy, so that the chance of sticking to the strategy is much higher. The moment you are sticking to the strategy, definitely you would be able to stick to it and make profits on the long run.
I think, Kiru, a lot of takeaways for me also personally, and one of the biggest takeaways that I'm sure a lot of people would be having is that the common thought process when backtesting is that once you have a backtest, people jump to tweak different parameters. For example, you have a parameter of 0.4% in your particular strategy. What majority would do is jump into testing zero point 0.3, zero point 0.5, 0.55. They would try to squeeze out that most profitable parameter by testing different stuff. But what you've essentially done is you've just backtested a single parameter, taken the results, and broken them down, and you have analyzed what exactly is causing a profit there or a loss. You've broken down into different elements, and you've essentially pulled out the stuff that is giving that strategy profits, and you've segregated it into different parts. And by doing that, you've essentially brought out a system that works very well on expiry days, and you've discarded the stuff that is not working. And
Exactly.
probably now people or someone can perform further analysis on this by testing different parameters. But the first and foremost process should not be to jump into different parameter testing. Instead, should be to understand how exactly that strategy is working and in what kind of environments is that working. I think that is a great takeaway from what you've shared with us.
Thanks, Arjun. That is the main thing. So, because no, it's like a toy you are giving it to a kid. Like no, a kid will keep on exploring the toy, but no, the backtesting platform, since it is much easier to access right now, most people are doing it in a wrong way. But they just have to zoom out and see. It's everything is there in front of their eyes. They just have to zoom out and see what is there in the data. And once you dig deep, definitely you could create a strategy out of it. This one I created in the morning. So
Wow.
for this for your presentation, I need to sit and work on it. So I was thinking what needs to be done. So I thought, okay, I'll work on it, and accidentally I came with a strategy. And I'm thinking right now, okay, this one works really well on Expiry. Probably I should add it to my own system as
You've given me some ideas too, and I'll start working on them now. Kiru, thank you for giving us insights into the kind of methodology you use for backtesting and how you analyze data. I am sure it will be helpful to the viewers and a lot of system traders that are watching this interview. It was an absolute pleasure talking to you. Thank you very much for giving us your valuable time.
Thanks, Arjun. Thank you so much for having me in this session. I hope people find it useful. We'll come up with multiple such sessions, and I should appreciate you guys because even the questions that you ask, it's no you do your homework. I could see that you are doing your homework and know what are the questions that people you need to ask with respect to each of the guest people are coming. And since you are also a trader, you are able to get the right questions from each and every guest, so that a trader who are listening to these podcasts, they'll also think, okay, these are the questions that I supposed to ask, but he is no rightly asking it. So you are getting the right questions and you are getting the right answers from the guest because of your questions. So you are doing a good job, Arjun. Keep doing it.
Kiru, when we have experienced speakers like you, we need to extract the best possible from you from your time. So I need to come up with the right questions. But thank you very much once again. Wonderful having you on the show.
Hey, thanks, Arjun.
So, guys, Kiru shared some amazing insights into his process of backtesting and analyzing a strategy. Hope you guys enjoyed it. Next week, we'll come up with another episode with another such experienced trader. Till then, keep liking, subscribing, and sharing our videos. And remember, ye market, sabka hai boss.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.